Next topic we have is adjusting journal entries. The first concept, it says matching revenues and related expenses. What does it mean? It means that your expenses for the particular period must be matched against the corresponding revenue in the same period. That's the foundation of accrual basis accounting, which means your revenues must be matched with the expenses in the same accounting period. Sometimes revenues or expenses are deferred or mean delayed, and sometimes they are accrued. What does it mean basically? Let us discuss these one by one. Unearned revenue means that you have collected money from your customers, but you haven't yet provided any service, you have not yet provided any goods. So this is not your income. So what you do, you debit your cash, credit unearned revenue. That is revenue that is not earned. Prepaid expenses. Prepaid expenses are the expenses that you have paid in advance. You haven't yet benefited from those expenses. So cash paid before the expense happens, like you pay rent in advance, that's what you call the prepaid expenses. Accrued revenues, these are the cash that you have received, but revenue was earned before that, like you make sale on credit, you will get money later. So accrued revenue means that you have earned it, but the cash will come later on. Similarly, accrued expenses means you pay cash after expense has been incurred. Like utility bill, you consume and then you pay at the end of the period. So unearned revenue, money received in advance for which no goods or services have yet been delivered. Prepaid expenses, expenses paid in advance before you actually incur the expense. Accrued revenues mean that you have earned the revenue but you haven't yet received the cash. And accrued expenses mean expenses have been incurred, they have not yet been paid. So we will discuss this according to some journal entries. So we'll discuss these journal entries as we proceed. This is it. When we receive cash for the goods or services that we will deliver, we debit cash and credit unearned revenue. And when you actually earn that revenue, you debit unearned revenue, credit revenue. Like for example, you receive $10,000 in advance against certain service. Once you deliver the service in full satisfaction to the customer, you then reverse this unearned revenue and can transfer it to the earned revenue. Similarly, if expenses have been paid in advance, for example, company may have paid the rent in advance for the next 12 months, so you debit the prepaid rent, which is basically a current asset, with credit cash. And when this expense is actually incurred, means you have paid 12 months rent, let's say, put some numbers to make it more understandable. You paid $12,000 and this covers the period from 1st of January 2024 till 31st of December 2024. Right now, the payment you made was made on maybe 31st of December 2023, right? So this whole 1 year rent has been paid in advance. What happens at the end of the year 2024? This 12,000, which was paid in advance, now becomes expense. Now what you do, you charge this to expense and remove the amount from prepaid expense and credit it. This way, the amount that was previously paid in advance, deferred, has now been expensed to income statement at the end of year, December 31st, 2024. So similarly, if we have fulfill all those 5 conditions of revenue recognition, we haven't yet received money from our customers, we can accrue revenue this way: debit account receivable, credit revenue. Remember, those 5 conditions must be met before revenue can be recognized. We saw that in detail in our revenue recognition. And when we have incurred certain expenses and we haven't yet paid them, we need to show them as expenses. We need to incur them as expenses because expenses have occurred. So we debit expense, credit accrued liability, and when these expenses are settled, we debit the accrued liability and credit cash and bank accordingly. Sometimes cash is recorded in the wrong account, like revenue or expense instead of asset or liability. Like for example, we pay rent for the next 12 months, $12,000. So instead of debiting prepaid rent, we simply debit rent expense and credit cash, which is wrong. So an adjusting entry is needed to fix this mistake, ensuring that the financial statements follow proper accounting rules. That's the basic idea. So what are the rules of adjusting journal entries? There's some basic ideas which you should remember. Adjusting entries must be recorded before the end of the fiscal year, before the financial statements are made. And these entries, they never involve the cash account. They are simply converting assets, expenses, or liabilities and expenses. So they simply affect income statements and balance sheet. They do not affect cash. This is an important point to be remembered. Adjusting journal entries, unearned revenue. On December 1st, year 1, Impact received $250,000 in cash for services to be performed equally during December year 1 and January year 2. Impact Incorporated recorded the entry as a credit to unearned revenue service revenue. Makes sense. That's right. So you debit cash, credit unearned service revenue. That's the entry. Cash debit, unearned service revenue. Okay, what happens next? It says that prepare the journal entries to record the unearned revenue on December 1st, year 1 and adjusting journal entry required at the end of the year. Remember this amount you received, it's for 2 months, that is for the month of December and January. Since the month of December is over, so that means half of this amount is earned revenue. So what we're going to do, we are going to remove half of this amount and transfer it to the revenue account, and this is what we do. We debit unearned revenue service, that is unearned service revenue, 125, half of it, and credit service revenue, so which means half of it has been moved to service revenue. And what we would do at the end of the month of January, we would transfer the remaining half by passing the same entry, unearned service revenue debit, service revenue credit 125. Adjusting journal entries, accrued interest. On November 1st, year 1, Impact Incorporated borrowed $2 million from Federal Bank at a rate of 3% with interest due annually on November 1st. Okay. The principal will be paid back on November 1st, year 11. That's about after 10 years. Prepare the journal entries to record the loan on 1st November, year 1 and the adjusting journal entries for the accrued interest at the year end. So first of all, you receive a loan. So you debit cash, credit, loan or note payable, whatever the term they might use, to record the journal entry from loan related from Federal Bank. And second part says the adjusting journal entry for the accrued interest at the year end. Remember, the loan was sanctioned on 1st November, year 1, full November, full December. That means 2 months worth of interest must be charged against income. So 2 months out of 12 times $2 million times the rate of interest, which is given as 3%. So 2 by 12 times 3% times 2 million gives you $10,000. So you are going to debit this as an expense. Debit interest expense, credit interest payable, because it hasn't yet been paid. So debit interest expense, credit interest payable. Let us do an extended example that should explain you the whole process of making adjusting journal entries at the end of the period. A comprehensive example, of course. Titan Company reported pre-tax income in year 2 of $8,000. Upon review of the journal ledger, the following information listed in the first column was discovered. We'll see. If necessary, record an adjustment to pre-tax income in the table provided so that income statement and balance sheet will be presented in accordance with the accrual basis of accounting. Prepare the adjusting journal entries required to record these adjustments. Unadjusted year 2 pre-tax income, $8,000. The company purchased a $300 3-year insurance policy on 1st of January year 2 and expensed it all on the payment date. The amount that we have paid for insurance is $300. At the end of the year, only $100 has expired, has become expense. So the remaining $200 at the end of the year should be moved to prepaid insurance. So we will debit the prepaid insurance account and credit the insurance expense account because insurance expense is overstated. Let me show you. Prepaid insurance debit, insurance expense credit. $2,000 of credit sales made during year 2 were not recorded in the ledger because they had not been collected in cash. So what? $2,000 was earned but not yet received, so it has to be recorded as an account receivable. So debit account receivable and credit sales revenue to match the revenue earned. Debit account receivables, credit sales revenue. Cash totaling $3,000 that was received in advance from customers was recorded to services revenue. Only 30% of the services had been performed by the year end. That means the total amount 3,000, 30% meant that's $900 has been earned. The remaining $2,100 is unearned. This $2,100 should move from sales revenue and it should move to the unearned revenue. So remember, this is the reduction in income and this would be reported as a liability. It's because this is the amount received but not yet earned. We do this by making the journal entry sales revenue debit, unearned revenue 21. This would show up as a current liability, and this would be the amount moved from sales revenue. The accountant discovered that a $450 utility bill covering the month of December had not been entered in the AP system, accounts payable system, at the end. It's an expense that would have been brought to the income statement. So you must debit expense. So you must debit expense. So that's why income statement would reduce, and it's a payable. So $450 for utilities was incurred but not yet paid. So we need to record utility expense, which would reduce income, and account payable would be credited to reflect the liability. Let me show you. Utilities expense debit, accounts payable, utilities payable credit, $450. $4,000 of rent was prepaid on 1st of January year 1, covering a 4-year rental period. No entry was recorded in year 2 related to this prepayment. Since it's a prepayment, so amount should move. No rent cash was paid this year, but $1,000 rent expense must be recorded. So what we will do, we would move $1,000 from prepaid rent, that's a reduction in the current asset, and we charge it as a rent expense, and this would reduce your income. So this is the charge against income, negative, and reduction from prepaid expense. So debit rent expense, credit prepaid rent. The direct write-off method means you simply debit bad debt expense and credit account receivable. This is not allowed under the US GAAP. If you need to write off a bad debt, you debit allowance for uncollectible accounts and credit account receivables. Not the way it's called direct write-off is not allowed under US GAAP. What is direct write-off? You debit bad debt, credit customer or account receivable. But the allowance method is permissible, in which you debit the allowance, credit account receivable. So it says that under the direct method was used and $650 was written off in year 2, although the company uses allowance approach to estimate bad debts. So if we rectify this, because under the US GAAP you do not charge bad debt directly to income, so you need to increase your income, because this is not a direct, the direct write-off is not permissible, right? So bad debt expense should be removed, should be reduced. Rather, it should be charged against the allowance for doubtful debts or allowance for uncollectible accounts. Let me show you the journal entry. So what happens? Allowance for doubtful accounts or bad debts or uncollectible accounts debit, and bad debt expense credit, which means this would be reduction from expenses, would increase your income as shown here. Your net income increases by $650 and your net current assets increase by $650. This is interesting. As you just saw that allowance for doubtful account was being debited. This debit would reduce the balance available in allowance, and since allowance is shown as a reduction from your gross receivable, so your net current asset would increase. That's a little interesting concept. Let me explain with the help of some numbers that will help you understand the idea. So this is the original situation where we simply wrote off the customer by debiting the bad debt expense and crediting the account receivable, and that's the situation. When we make this rectifying entry, allowance for doubtful account is debited. Debited means the $650 is debited against this allowance. This is the allowance for uncollectible account. The balance in allowance would reduce from $1,650 to $1,000. Your account receivables stay the same. Resultantly, your net receivables would increase by $650, and net increase in receivables is increase in your current assets. The company purchased $1,300 of raw materials at year end, which were shipped FOB shipping point and were in transit at the end of the year. The goods were not included in the actual year-end inventory count. The effects of this correction on the financial statement is the same whether the perpetual or periodic inventory system is used. That is not relevant for the point we're doing right now. What the goods were shipped FOB shipping point, which means as soon as they were shipped, they belong to the buyer. But buyer, us, we did not post any entries to reflect this purchase. So now we should. So we should debit our purchase, credit our accounts payable if you are using periodic inventory, because in periodic inventory system we debit purchase, credit, accounts payable. But if you are managing perpetual system, in that case you debit inventory account, which is a current asset, and credit accounts payable. Debit inventory in case of perpetual or purchases in case of periodic, and credit accounts payable. The company purchased available for sale securities during year 2 for $1,500. The fair value at the year end totaled $2,000. There is an appreciation in the price, but no adjustment to fair value was recorded in the ledger. You should increase the value of your investment by 500. At the same time, the extra $500 goes to your other comprehensive income, OCI. Remember, available for sale security, any fair value gain and loss goes to OCI. So the entry we make is, we debit valuation account, that is fair value adjustment, $500, and credit unrealized gain on available for sale securities. This goes to other comprehensive income. We will discuss this as we proceed.